A factory can sell a product at a fair market price and still leave someone else paying part of the bill. Smoke in the air, noise near homes, traffic around a warehouse, or cleaner streets after a vaccination all show the same idea. Some costs and benefits spill beyond the buyer and seller. Traffic congestion is a simple example. The driver gets where they need to go, while nearby residents deal with noise, delay, and pollution. One overlooked detail is that parking pressure can follow one popular business. An externality is a side effect of an economic activity that affects people who are not directly part of the transaction. The buyer pays, the seller receives money, but a third party may gain or lose without choosing the deal. That outside impact is the externality. Packaging waste shows how a cheap product can push cleanup costs onto households, cities, and public spaces. This becomes concrete when a cleaner street can benefit owners who did not pay. Negative externalities are costs pushed onto others. Pollution is the classic example. If a company makes cheap goods but nearby families breathe dirty air, the store price does not include the full cost. The missing cost shows up in health problems, cleanup expenses, and lower quality of life. A neighborhood can absorb costs from a business decision even when residents never agreed to the trade. Positive externalities work in the opposite direction. A person who gets vaccinated may protect themselves, but they also reduce the chance of spreading illness to others. A homeowner who improves a neglected building can lift the appearance and value of the street. The benefit travels beyond the person who paid. For example, noise is treated as a real condition rather than background noise. Markets struggle with externalities because prices send incomplete signals. If a product is cheap only because part of the cost is hidden, buyers may purchase more than society would choose if the full cost were visible. The market is responding to the price it sees, not the damage it ignores. Noise is not just an annoyance when it affects sleep, study time, property enjoyment, or local business activity. Imagine a delivery company using noisy trucks late at night. Customers enjoy fast shipping. The company earns revenue. Residents who cannot sleep are not part of the purchase, but they carry part of the cost. That missing piece can create conflict even when the business is legally selling a useful service. Noise from a late-night venue can disturb nearby families even if the customers and owner both benefit. Externalities help explain why private profit and public welfare can diverge. A decision can be rational for one firm or household while still producing a bad result for the wider community. Economics becomes more realistic when it asks who else is affected, not only who paid. Traffic congestion turns one driver's choice into delays for hundreds of other people on the same road. Governments often respond with taxes, rules, permits, or limits. A carbon tax tries to add the environmental cost into the price of fuel. Noise rules restrict behavior that harms neighbors. Waste regulations force producers to handle costs that would otherwise land on the public. This matters because traffic congestion is treated as a real condition rather than background noise. Subsidies are common for positive externalities. Education, vaccines, public transit, and clean energy may receive support because the benefits spread outward. The idea is not that every subsidy is automatically good. The logic is that useful spillover benefits may be underproduced if individuals must bear all the cost alone. A noisy venue may benefit customers and owners while nearby families carry the cost each night. Private bargaining can sometimes solve the problem. If a beehive helps a nearby orchard pollinate crops, the beekeeper and farmer may agree on payment. But bargaining becomes harder when many people are affected, the damage is hard to measure, or the responsible party is difficult to identify. Spillovers matter because the people affected are often outside the original buyer-seller exchange. Property rights matter. If a river has no clear protector, factories may treat it like a free dumping area. If rules define who can use it and who must pay for damage, behavior changes. Clear rights do not solve every case, but they make responsibility easier to enforce. Congestion pricing, noise rules, and waste fees are attempts to pull hidden costs back into the decision. A mistake is thinking externalities are only environmental. They appear in traffic congestion, loud construction, secondhand smoke, antibiotic resistance, social media misinformation, and even well-kept gardens. The central question is always the same: who is affected outside the deal? A person can notice this when traffic congestion is treated as a real condition rather than background noise. Another mistake is assuming all externalities need the same solution. A small neighborhood noise issue may need local rules. Industrial pollution may need monitoring and penalties. Public health spillovers may need education and access. The right response depends on measurement, incentives, enforcement, and fairness. Once the effect is measured, the question becomes whether the cost should stay with neighbors or be priced into the activity that creates it. Businesses also face externality pressure from consumers and investors. A company that once ignored packaging waste may change when customers demand less plastic or when disposal rules become stricter. The outside cost becomes harder to ignore when reputation, regulation, or buyer behavior changes. Externalities can hide for a long time. Groundwater contamination, climate effects, traffic patterns, and antibiotic resistance may build slowly. By the time the cost becomes obvious, the behavior causing it may be deeply embedded in habits, infrastructure, and business models. The practical value of the concept is simple. Do not stop at the buyer and seller. Ask who else pays, who else benefits, and whether the price reflects the true impact. That question turns a private transaction into a wider economic picture. Externalities show why markets are powerful but not perfect. Prices coordinate millions of choices, but they can miss spillover costs and benefits. When that happens, society has to decide whether to adjust incentives, set limits, support beneficial behavior, or accept the consequences. A neighborhood example makes the idea less abstract. If one restaurant becomes popular, nearby shops may benefit from extra foot traffic even though they did not advertise. At the same time, residents may deal with parking problems and late-night noise. One business success can create both positive and negative spillovers. Externalities also explain why individual freedom and public rules collide. A person may say they should be free to use their property however they want. Neighbors may reply that smoke, noise, drainage, or traffic crosses the property line. The conflict begins when private action creates public effects. The hardest cases are often measurement problems. It is easier to count the price of a product than the asthma visits, road delays, lost sleep, or cleaner air that follow. Good policy depends on making invisible costs visible enough to discuss honestly. In the end, an externality is the part of a deal that escapes the receipt. The money changes hands between two parties, but the effect may travel through air, roads, health, neighborhoods, or future budgets. Understanding that hidden trail is what makes the idea useful.